Hey, everybody out there. We called back Mark Collinsworth very quickly today following news of the Silicon Valley Bank collapse. And we're going to ask him, the man of the hour here with all the financial know-how, is this going to have a ripple effect? Should we be afraid? Mark.
Well, thank you, Larry. It will have a ripple effect, but I don't think you need to really be afraid at this point. Silicon Valley Bank is kind of an isolated event to a degree. There were some additional problems going on with Silicon. One, part of the problem is the Fed raised interest rates, which caused their balance sheet for their bond holdings to go down in value. That was problem number one. Problem number two, people started pulling money out because Silicon Valley Bank was offering 2% yields on money market accounts. Why do you want to get 2% when you can go and get a UST bill and earn 5%? And then the third part of the problem is Silicon Valley, out of all the banks out there, 57% of their assets were actually tied up in things that were more exotic, venture capital funds, hedge funds, because Silicon Valley might be a bank, but technically it's really not a bank at the same time either, if that kind of makes sense.
All right. So will it affect other banks? Will people, regular people with deposits in their local bank, uh, do they have to worry that this is going to have a domino effect?
Well, yes and no. If you're dealing with a regional bank, then that's kind of the problem. Is Silicon Valley, as the name suggests, Silicon Valley, it did a lot of business with tech startups. And so it was the bank to go to for tech startups. So all these little tech companies that basically didn't have a lot of money, but they wanted to protect their money, they started going into a mad rush pulling money out Thursday morning because it's better to be safe than sorry. And if you're curious, from Thursday morning until this morning, Silicon Valley, they pulled $42 billion got pulled out of the bank from all the little people pulling money out.
All right. Well, I'm not a tech investor. I go to a local bank here in Pennsylvania. So what I'm asking is, will that have an effect on, you say regional banks? I guess those are local banks. Will that have an effect on, banks that ordinary people go to?
No, I don't think so because most of those banks don't do the crazy stuff like the hedge funds, the venture capital, the PCs. They don't do that same VCs. They don't do the same thing that Silicon Valley does. Now, those same banks are going to run into problems because they do own bonds and bonds have gone in down in value. And that's kind of the second issue here. Starting in April, all banks have to report their stress test of their balance sheets to the Federal Reserve, and those numbers don't become public until June. So if you're an investor in a bank right now, you won't know if your bank passed the test or not until June.
All right. So, Mark, part of this stems from the Fed raising interest rates in order to combat inflation, correct?
That is correct. They kept on piling it on. The problem, they raised interest rates way too fast and way too much, and these banks just could not adjust their balance sheets fast enough with letting stuff roll off. The Fed, at the same time, to stop this problem, the Fed should have been slower in raising rates. But then again, if they're slower, then the long term problem is inflation gets dug in more and more. So it's one of those things you're damned if you do and you're damned if you don't.
Well, Mark, despite your reassurances, a lot of people, are thinking back to the run on banks, most famously, what caused the depression in the 1930s after Black Friday, and also more recently, 2008, where it did have a ripple effect generally throughout the economy. So you're saying that this is not a parallel situation, and there's no danger of it getting that much of a ripple effect across the United States.
Correct. I don't think you're going to see a mass. I don't think companies like JP Morgan and Wells Fargo are going to run into problems because they're so much more diversified with global operations. They have so many other ways to make money. Whereas really Silicon Valley had just a very narrow way of making money. I think that's where a lot of the problem came in at. But at the same time, these banks, all your banks are going to have problems. And I like to always use the analogy, think of Silicon Valley as a cockroach. When you see a cockroach in your house, you're not going to have just one. So you're going to see some other problems. I just don't think the problems are going to be as bad as Silicon Valley. And while we're on it, in case just a little history lesson here, Silicon Valley was the 18th largest bank in the United States and is the second largest U.S. bank failure in U.S. history.
Right, which seems, pretty severe. So apparently the company's downward spiral began on Wednesday of this week, uh, when it told investors that it needed to raise 2.25 billion to shore up its balance sheet, and that became, a tumble situation where everything went downhill from there. What it did was basically induce a panic, correct?
Correct. What happened, that goes back to those venture capital funds. So since it's in Silicon Valley, Silicon Valley Bank deals a lot with holding money for what they think is going to be the next Facebook, the next Microsoft, the next Apple computers. And so these companies, these private equity investors had given money to what they think is going to be the next Facebook or the next, Microsoft. And Silicon Valley is the bank that they use because they cater to those kind of investors or those kind of depositors. And Thursday afternoon or Thursday morning, those private equity investors were saying, "Hey, let's play it safe. Let's get your money out of Silicon Valley Bank." And so there started a bank run, which came to basically $42 billion got pulled out within 2 days.
And that's what led to the seizure of the bank, right? Because the bank couldn't meet it.
Correct. And that's just like, with Bear Stearns. Bear Stearns had enough money on its balance sheet that it could have held out for a lot longer than what it did. But when you started seeing all the news on TV and everything, there was a bank run on Bear Stearns. And I don't care how strong of a bank you are, you get $200 billion pulled out of your bank in 24 hours, you're going to have some problems.
Yeah, well, this wasn't the only bank that failed recently. There was also, what was it, Silver?
Silvergate, which was a Bitcoin bank.
So that was another kind of unusual
Yeah.
stuff.
Yeah.
Yeah.
I mean, a Bitcoin bank should have gone bankrupt a long time ago.
All right. Now, following this news today, in terms of panicking people, some of the financial numbers are going to be coming in this week, correct?
Quick, we had unemployment numbers actually came out this morning, but Silicon Valley Bank kind of overrode that. No one really cared about the unemployment numbers. But the unemployment numbers did come in much stronger. But there was a lot of panic selling in the stocks. And so bonds actually had a fairly good day.
The jobless report came in with stronger numbers than expected, which isn't necessarily good news.
That is not because the Federal Reserve that we discussed a few days ago. Federal Reserve's not having a lot of effect on the consumer. Used to in the past, when the Fed raised interest rates, so many consumers were on variable mortgages. When the Fed raised rates, their mortgage payments went up, and that took some money out of the pocket. This time, the bulk of your mortgage holders are now fixed. So when the Fed raises interest rates, it doesn't really have a big effect on the consumer because they don't see their mortgage go up. But in the case of Silicon Valley, it has a bigger effect because prior to 2008, Silicon Valley paid its depositors, let's say 2% in interest on its bank deposits. Fed raises interest rates, mortgage rates go up. The higher mortgage rates allow them to pay more money to depositors. Now the bank can't raise interest rates on its deposits because the portfolio is fixed income.
Yeah, well, also what's looming later this month would be the Fed deciding if they're going to raise interest rates again. And it's Jerome Powell, the chair, has already hinted strongly that it's going to be another hike in probably maybe 50% or even 75% percentage points. So basis points. So that in itself is going to add to this perception of economic turmoil.
Well, correct. And even today, now people are saying the Fed can't raise interest rates at the next meeting because if they raise interest rates, they're going to create a domino effect and there'll be another Silicon Valley bank down the road. So they're back in the situation. They're damned if they do and damned if they don't.
So the summary of this is it's not a stable situation.
It's not. If I had to guess, the Fed's still going to raise interest rates because, unfortunately, after March of 2020, when the economy went down the toilet, we had negative 30% GDP. The Fed also discovered, hey, if you throw $2.5 trillion at the problem, you can fix it. What I don't want the Fed to get into is say, hey, we can keep on raising rates and get the Fed funds rate up to 6.5, maybe even 7%. And if it breaks at that point, we can just throw another $2 trillion at the problem and fix it. That's not a good way to look at it.
Before we close, we should talk about the effect of the banking regulations, which were changed, and that caused the breakdown in 2008. So go through that for us.
Correct. In 1999, the Glass-Steagall Act was repealed. The Glass-Steagall Act was the banking regulations that was put in during the Great Depression to make sure another Great Depression never occurred. And it was very simple. The Glass-Steagall Act simply said banks absolutely cannot do these things. They got rid of the Glass-Steagall Act, which opened up the door for banks to start doing the stuff that led to the housing bubble. And it's
And what was that stuff that it prevented them from doing in Glass-Steagall?
it basically said banks can only do loans. That's all banks can do. They can do mortgages, they can do, personal loans, they can do car loans, but they cannot invest in private equity. They cannot invest in hedge funds. They cannot use leverage. They cannot invest in the stock market. After the Glass-Steagall Act was repealed, guess what? All those things that one of the things that caused the Great Depression, it opened the door up and allowed all those things to be done again.
Glass-Steagall was put in effect in reaction to the Great Depression.
Correct, to make sure another Great Depression did not occur.
And that was back when?
1932 or 1933.
Okay, so for decades it worked well. Then the Clinton administration decided to yank it.
Correct, because they thought more people should be able to buy homes because there was very strict regulations on what allowed a bank to actually issue a loan. You probably heard about, people in 2008 were getting, $500,000 mortgages and didn't have a job and had no income and no assets, but banks were just rolling these things out left and right to them. Under the Glass-Steagall Act, that would have never occurred.
So Glass-Steagall was yanked in 19 what?
Glass-Steagall was repealed in 1999.
And then because of what happened after that, the banks went wild. They became like casinos.
There was really no regulation stopping them. There was nothing. You're right. They became casinos. There was no regulation stopping them from doing what they want to do.
So then supposedly to remedy that, they put in the Dodd-Frank Act. And how is that?
Well, it's not working better because whereas the Glass-Steagall Act said you absolutely cannot do this, there's no ifs, ands, or but. The Frank-Dodd Act has, well, you can do it if you do this and you do that, or you do this, you can do it.
So, and when was that put in place?
That was put in place, I believe, in 2010, 2011.
All right. So the Dodd-Frank Act then isn't really a stabilizing factor.
No, it is not. And it actually makes it worse because we're in 2008. The government went and did what the bailouts, where the government basically gave money to JP Morgan and Wells Fargo and stuff. The Dodd-Frank Act now has what's called bail-in. So the U.S. government has said we will not bail out any banks in the future. And what that means is that the next big banking crisis that we have, instead of the bank writing the check out, unfortunately, the individual investor will have to write the check for that to bail in the banks per se.
And when will that next big banking crisis occur?
Oh, well, I'm a strong believer in the 100-year cycle. So I've got it pegged somewhere around 2030, 2031.
Wow. But until then, we could live it up, sort of, right?
You can kind of live it up before we start going down. Yes.
Okay. Mark Collinsworth, thanks for those reassuring words tonight. I guess, I don't know. We'll see what happens. I think there's a lot of fallout this week from this.
Well, I know, Larry, and today was a bad day in the stock market. I'm sure a lot of people are upset, but remember, it's always the darkest before it gets really freaking bad.
Closing words from Mark Collinsworth of Vere Global Wealth Management Financial Company. Mark, thanks for being with us, I guess.
You're welcome. Thank you.